Good evening. We begin tonight with significant volatility in the silver market following a dramatic price swing over the past 24 hours. Silver, which had fallen sharply to $82 during the previous trading session, rebounded to $85 as of midday Wednesday, March 4, 2026. The $3 recovery occurred in less than one full trading session, marking a rapid V-shaped reversal after what had been described as intense selling pressure in the paper futures market. During Tuesday's decline, leveraged positions faced widespread margin calls across major financial centers, including New York and Singapore. Automated trading systems accelerated the selling of futures contracts as institutions moved to meet collateral requirements. Retail investors holding paper positions experienced steep losses as prices fell to the session low near $82. Financial media coverage characterized the drop as a breakdown in the safe haven trade, while commentary pointed to renewed strength in the US dollar. However, within 24 hours, the market shifted. By Wednesday midday, silver had climbed back to $85. According to the narrative presented, the earlier decline was attributed to what was described as a mechanical liquidation event tied to the T+1 settlement structure. Once margin obligations were met and forced selling subsided, buying activity resumed. The result was a swift recovery in price. The legal case centers on tariffs that were introduced during the administration of former President Donald Trump. These tariffs were implemented under emergency economic authority and were applied broadly to imported goods entering the United States. For several years, many American companies paid these tariffs when bringing products into the country. Importers across multiple industries argued that the measures placed a heavy financial burden on their businesses. In the recent court ruling issued in New York, the judge determined that the government must stop collecting the tariffs immediately and begin reimbursing companies that previously paid them. Thousands of importers are now expected to receive refunds for the payments they made while the tariffs were in effect. Although the exact total amount of the refunds has not yet been fully calculated, analysts observing the case suggest the combined payments could reach tens of billions of dollars. Because tariff revenue is collected by the federal government and added to government funds, returning that money now requires the government to finance the reimbursements through available budget resources. The issue becomes more complex given the current fiscal situation of the United States. With national debt already standing at roughly $34 trillion, any large-scale repayment obligation raises questions about how the government will manage the additional financial requirement. Some observers point out that the government does not maintain a separate reserve specifically designated for tariff refunds. As a result, the refunds will likely have to come from the same broader financial system used to fund other government obligations. This includes the issuance of new government debt through Treasury securities or the use of general federal funds. Either approach would effectively shift the financial burden into the existing government financing structure. The financial impact of the court ruling becomes more significant when viewed within the broader context of current government obligations. The United States government already faces large and ongoing spending commitments, including interest payments on the national debt, defense expenditures, social programs, and other federal responsibilities. With national debt standing near $34 trillion, any additional financial obligation requires careful budget management. If the government must return tens of billions of dollars to importers who previously paid tariffs, those funds must come from existing financial channels. One possible method is the issuance of additional Treasury securities. Treasury bills, notes, and bonds are regularly used by the government to finance spending when revenues are not sufficient to cover obligations. By issuing more securities, the government can raise the capital needed to fund repayments. Another possibility is reallocating funds from the broader federal budget. However, shifting large amounts of money from other programs may be challenging given existing commitments across multiple areas of government spending. As a result, analysts following the situation have suggested that additional borrowing could become the most practical mechanism. Financial markets often respond closely to changes in government borrowing levels. When new Treasury securities are issued, they are purchased by investors ranging from large financial institutions to pension funds and international buyers. These securities represent a claim on future government payments and are considered a core component of the global financial system. Because of this connection, developments involving federal finances can influence broader market conditions. Investors frequently monitor government debt levels, borrowing activity, and fiscal policy decisions as part of their overall market analysis. The tariff refund case therefore extends beyond trade policy and enters the wider discussion surrounding government financing and economic stability. As the situation develops, market participants are closely watching how the government will implement the court's decision and manage the financial implications. The immediate requirement is the halt of tariff collection and the process of identifying companies eligible for reimbursement. This administrative process may take time as authorities review records of payments made by importers during the period when the tariffs were in force. For businesses that paid the tariffs, the ruling represents a potential financial recovery after several years of absorbing higher import costs. Companies across sectors such as manufacturing, retail, and logistics had incorporated those additional expenses into their pricing structures and operational budgets. The reimbursement process may therefore return significant capital to firms that had previously accounted for the tariffs as a cost of doing business. At the same time, policymakers and financial analysts will continue evaluating the broader fiscal implications. If the total refund amount reaches tens of billions of dollars, the repayment could become a notable line item within federal financial planning. The government will need to determine how the funds are distributed, the timeline for repayments, and the mechanism used to finance the obligation. Investors and market observers are also paying attention to how financial markets respond. Government borrowing levels, budget management strategies, and broader economic conditions all play a role in shaping investor expectations. Because Treasury securities are widely held across the global financial system, any change in issuance patterns can influence market sentiment and liquidity. For now, the key development remains the court's decision, requiring the government to stop collecting the tariffs and begin reimbursing companies that previously paid them. The long-term financial impact will depend on the final scale of refunds, the government's financing approach, and how markets respond as the implementation process moves forward.